Welcome to Cotality's Housing Market Update for July 2025. Australian housing values rose another 0.6% in June, marking a fifth straight month of growth since conditions flattened out through the end of last year. Demonstrating the broad-based nature of the upswing, monthly gains were recorded across almost every broad region of Australia, with Hobart the only region to see a month-on-month fall. The first rate cut in February was a clear turning point for housing value trends. An additional cut in May and growing certainty of more rate cuts later in the year have fueled housing sentiment, helping to push values higher. Although value rises have been broad-based, the quarterly pace of growth at 1.4% remains mild compared to the mid-2023 levels when the national index was rising at the quarterly rate of 3.3%. Current growth levels could be described as almost tepid compared with the extreme 8.1% quarterly rate of growth recorded through the height of the pandemic. Across the individual capitals, quarterly growth was led by Darwin, with dwelling values jumping 4.9%. That was enough to take the market to new record highs, finally surpassing the mining boom peak recorded over 11 years ago in May of 2014. Outside of Darwin, the quarterly trend across the capitals was led by Perth and Brisbane, the same markets which have led the 5-year growth trend, with values up 81% and 75% respectively since June of 2020. Although the quarterly pace of growth still favours regional Australia at 1.6%, compared with the combined capitals at 1.4%, it's looking increasingly likely that the quarterly trend will once again favour capital city markets over the coming months. In fact, the last 2 months have already seen the combined capitals record a slightly higher rate of capital gain than the regional markets. The housing rebound is occurring against a backdrop of relatively low home sales, with turnover through the first half of the year tracking at an annualised pace of 4.9%. That's slightly below the decade average of 5.1%. Although demonstrated demand is tracking slightly below average, advertised supply is scarce, creating more balanced markets for buyers and sellers. Advertised stock levels are tracking 5.8% below the same time a year ago and 16.7% below the previous 5-year average. Low inventory levels are supporting an improvement in selling conditions, which can be seen in auction clearance rates. They rose to slightly above the decade average in the last 2 weeks of June, holding around the mid-60% range. Turning the focus to rental conditions, rental growth has continued to ease across most of Australia, with the National Rental Index rising 1.3% through the June quarter. That's the lowest Q2 change since 2020. The slowdown in rental growth is more visible in the annual trends, where the national growth rate has eased from a peak of 9.7% in November 2021 and where it was tracking more than 8% between July 21 and May 24. The National Rental Index was up 3.4% through the financial year, the lowest annual increase since February of 2021. Slower rental growth comes despite vacancy rates consistently holding around the mid-1% range, well below the pre-pandemic 5-year average of 3.3%. Rental affordability is a key factor keeping a lid on rental growth. Assuming the median rent and the median household income, rental households are now dedicating around 1/3 of their pre-tax income to paying rent. As the period of COVID catch-up migration comes to an end and recent temporary migrants head back overseas, net overseas migration has reduced close to pre-pandemic levels. Because most recent overseas arrivals tend to rent, slower rates of net overseas migration are also contributing to the slowdown in rental demand. The pace of capital gains has re-accelerated across the Perth market, with the monthly rate of growth rising to 0.8% in June. After posting 3 months of negative change between December and February, monthly movements in Perth dwelling values have been consistently positive, taking the quarterly rate of growth to 2.1%, the highest since the 3 months ending October last year. Through the financial year, Perth dwelling values are up 7%, or in dollar terms, approximately $54,000. Despite the strong annual growth outcome, the annual rate of growth is less than a third relative to a year ago, when Perth housing values are rising at 24.4%. A range of factors are set to shape housing market outcomes over the rest of the year. On the upside, we have an expectation that interest rates will fall further over the coming months, possibly reducing to the early 3% or even high 2% range by year's end. Consumer sentiment is likely to improve, while labour markets are holding tight. Additionally, persistently low levels of new housing supply are likely to support housing values. With the monthly inflation indicator for May showing a 2.4% core inflation rate, inflation is well and truly back within the RBA's target range of 2 to 3%, beating the RBA's forecasts, which had trimmed mean inflation holding at 2.6% from mid-2025. The lower-than-expected inflation outcome has prompted many economists to bring forward their forecasts for future rate cuts, with a consensus view forming that rates will fall another 25 basis points in July, with more rate cuts to follow. Financial markets are pricing in a cash rate of 3.1% by December and 2.9% through the first quarter of 2026. Lower interest rates go further than improving just borrowing capacity and serviceability. Along with reduced cost of living pressures, we should also see the lower cost of debt providing some support for consumer sentiment and high commitment decision-making. The tight labour market, with the unemployment rate holding around 4.1% or lower since early 2022, should also support confidence and borrowing ability. Concerns about labour markets being too tight seem to be fading, with no evidence of a blowout in wages growth. From a housing supply perspective, the rise in dwelling approvals from the cyclical lows of 2023 and 24 looks to have been short-lived, with the monthly numbers faltering below the decade average and holding well below the 20,000 approvals required each month to reach the Housing Accord targets. Insufficient levels of new housing supply are likely to place further upwards pressure on housing prices at a time when housing affordability constraints are already at record levels. Downside risks relate to the widespread affordability constraints, elevated levels of household debt, and a cautious lending environment, as well as reduced housing demand via population growth. Geopolitical risks are another factor that could weigh on sentiment. Given the ongoing affordability constraints evident across most markets, it's hard to see value growth posting a material upswing. The 2.4% rise in national dwelling values through the first half of the year equates to a dollar value increase in the median value of approximately $19,000, eroding much of the benefits of lower rates when it comes to borrowing capacity. Household debt levels could weigh on credit availability, with a ratio of household debt to disposable income tracking at 181% in the March quarter. While that's down from historic highs, the risk of households accumulating excessive levels of debt as financial conditions ease is something the Council of Financial Regulators has on their radar. Lower population growth should also help to quell the accrual of housing demand in the absence of a supply response. Finally, geopolitical risk relating to conflicts in the Middle East, US tariffs, and the ongoing Ukraine war remains a wild card that could weigh on consumer sentiment and potentially disrupt economic conditions. Overall, the tailwinds of lower interest rates, higher confidence, tight labour markets, and low housing supply are likely to outweigh the headwinds, providing the foundations for further modest growth in housing values in 2025. But we aren't expecting growth conditions to be anywhere near as strong as what we saw through early 2023, or for that matter, the height of the pandemic housing boom. There's always plenty of intra-month updates flowing through from the Cotality research team. You can stay in touch with all things housing at the news and research pages of our website.